David Garofalo, Chairman and CEO of Gold Royalty Corp, joins us today. He was former CEO of Goldcorp, one of the largest miners in the world at one time. David, it's such a pleasure to speak with you today. Welcome back to Kitco.
Thanks for having me on.
There's a host of topics we'll cover today, but let's start with your market outlook, because after you left Goldcorp, you've been involved with several projects, one of them being a gold fund. So you are CEO of the Marshall Precious Metals Fund. What's it like managing the other side of the hedge, so to speak?
Well, I've deliberately positioned myself at this point in my career to development stage end of the spectrum, because the dynamic in the sector is such that we've seen reserves actually decline by about 50% in the last decade, because companies and the producers in particular have been focused on margin, profitability, returning capital to shareholders as they should. They should be running their businesses as businesses, but exploration's been sacrificed. And that's become an existential issue now for the sector. With reserves declining, that's a leading indicator of where production is going to go. So they're going to have to redeploy capital and refine that lost art of mine construction. So I've set up this fund, the Marshall Precious Metal Fund, to invest in early stage exploration. And really until about 6 months ago, the juniors couldn't raise a dime to save their lives. And now they're starting to see an influx of capital because the market and producers are starting to recognize they need these juniors to be successful to replace a depleting reserve base that they're all enduring right now.
Okay, so you've obviously spoken to some other fund managers in the industry. What are they thinking? How are they feeling about the space right now? Like you said, we've seen an influx of capital. Is this cause for celebration or concern, because it has gone up very quickly?
No, I think it's cause for celebration. And the good thing is we are starting to see some of that capital deployed into these early stage opportunities, both in terms of grassroots exploration through the juniors. And a lot of them have been able to recapitalize themselves and deploy capital into the ground. But what we haven't seen is development stage opportunities really enjoy that influx of capital, but inevitably they'll have to. The ones that are in, say, the PEA stage, pre-feasibility or feasibility stage, the ones that are going to represent pipeline opportunities for the producers are going to have to see an influx of capital, I think, in short order. They haven't seen that yet. The focus has been more in terms of a barbell approach by portfolio managers, either investing in early stage exploration, I think in the case of specialist funds, or producers, established producers, large cap for, say, the generalist equity investors and the non-specialists. We have to start to see some of that capital come into the middle of that barbell, because the producers do need to replace their depleting reserve bases and inevitably their declining production profiles.
Well, the scarcity works in the favor of the junior gold miners, right? Because according to some analysts I've talked to, the scarcity that you're mentioning actually helps with the prices long term. Do you disagree with that viewpoint?
Look, I think supply speaks more to sentiment than fundamentals. So I do see declining supply. Obviously, declining reserves lead to declining production profiles. I think that's positive for the sentiment towards gold. But I always have believed that gold is a demand-driven market. And what's driven demand more than anything else is low interest rates. The lack of opportunity costs in owning physical gold has driven capital into that. Gold, at the end of the day, is really not a commodity. It's a currency. It has been for millennia. It's the longest standing currency that man has ever known. And I think the market's starting to appreciate the capital preservation characteristics that gold provides, particularly in an environment where sovereign debt is yielding negative, both in nominal and real terms. You might as well own gold when fiat currencies are being printed with reckless abandon.
Right. Okay. So you started a gold investment fund focusing on juniors. Do you expect a lot of M&A going forward then?
Yeah, inevitably the juniors that are successful in finding something prospective, finding something that geologically has economic potential, are going to get snapped up by the established producers. And that's why I've gotten involved with Gold Royalty Corporation and its parent company, Gold Mining. Gold royalty companies are integral to finding capital to put into the ground to build new mines. In the past cycles, when we've seen a deployment of significant capital into mine construction, the royalty players have played a significant part in providing financing for those. So I wanted to get involved in a royalty vehicle that would provide that capital at much more efficient rates than, say, raising equity at the junior side. And then Gold Mining, the parent company, owns a collection of 14 development stage assets against which we wrote royalties. We have 14 royalties against those development stage assets that we put into Gold Royalty Corporation. And that gold mining vehicle, the parent company, which is public, it's gold on the Toronto Stock Exchange, it has accumulated a portfolio of 25 million ounces of reserve and resource within those 14 development stage assets. And there are large ones, medium-sized, and smaller-sized ones. And so they'll appeal to a broad array of producers that are looking for pipeline projects that they'll want to earn into, joint venture, in order to replace their depleting reserve and production basis.
Okay, so based on your thesis here, where do you see gold prices headed from here?
Look, I think Merrill Lynch came out with a forecast of $3,000 an ounce over the next 18 months. And that's quite telling to come from a bulge bracket US dealer. Typically, gold is perceived as a barbarous relic by the mainstream investor community and mainstream media. And Merrill Lynch did not pick that number out of the air. If you look at gold's all-time peak in real terms, it was back in the early 1980s when it was over $850 an ounce. If you translate that into 2020 dollars, that's close to $3,000 an ounce. So I don't think it's a coincidence that Merrill Lynch has come out with a forecast of $3,000 an ounce. I think that's at least the next leg up for gold over the next 18 months to 2 years.
Okay. You're one of the few execs who have a triple crown of leading a senior, junior, and now a royalty as well. So I'm going to pick your brain on all three of those. Actually, I don't even know if the triple crown term is a real thing, but I'm starting it now. As of now, I'm starting it with you. So let's start with your experiences with Goldcorp. You were involved in the merger between Goldcorp and Newmont. You advised on that deal. Tell us about that experience. Were the terms of that M&A, could they be replicated today?
Look, well, there are very few players at the top. I mean, Barrick merged with Randgold, we merged with Newmont. There are very few players that are going to be able to dance with each other at the top anymore. I think large-scale consolidation is by and large done. I think it's going to be the mid-tier where there's been a proliferation of emerging producers and mid-tier producers. There are probably too many of them, and they're all facing depleting reserve and production profiles, and they haven't had any significant success on the exploration side. And if you're not finding it, you're going to have to buy it. Those guys are going to have to start to rationalize. And so I'd say over the next 12 months, you're going to see when we can open up the universe to actually do physical due diligence again of each other's properties post-COVID, I think you're going to see a long line of M&A deals in the mid-tier space and the emerging producer space, the smaller scale producers. There's way too many of them, and they risk irrelevance. They don't have the scale to attract the generalist investors. They don't have the liquidity in trading, and they're going to have to scale up. And a great example of that is when Equinox did Leah Gold and Bria Gold. Those companies all merged in stages. They created a large scale, large cap producers, and they re-rated as a result. I think that is an illustration of what can happen if we start to see some of these smaller producers start to put themselves together, create enough scale and liquidity in the marketplace to achieve a re-rating.
When we're looking at the premiums of M&A deals, how much of those are dependent on the gold price level? Because the higher the gold price, the better the sentiment from investors, the more capital flows into the space. When you were on that deal with Newmont, the gold price then was nowhere near as high as it is now.
Well, actually, it was doing fairly well. You're right. It wasn't at $2,000 an ounce, but it was showing a strong upward trajectory. The issue for both Goldcorp and for Newmont, and for that matter, Barrick and Randgold, is all of us collectively were facing, or individually were facing, declining reserve and production profiles. And so what those two mergers allowed these companies to do was to create sufficient scale in order to maintain a flat production profile for the foreseeable future. There was enough within the collective pipelines, within the collective portfolio of operations, that you could optimize the operational portfolio to achieve a steady state production profile and achieve cost efficiencies as you costed out these projects and realize synergies on a combined basis. So it was really about achieving scale and also sustainable scale. And that's what those two mergers did.
That actually leads to my next question is, when you're at the helm of a major senior being involved in a mega merger on that size, we've only seen really just two on that scale. What were your priorities in terms of having a strategic checklist? What were maybe your top? You talked about synergy, you talked about operational scale. Why? Basically, the bigger question is why would you even consider merging with Newmont, whereas Goldcorp was doing fine? What did you have on your objectives that you couldn't have done before?
Look, it was getting to that sustainable production scale, one that we could maintain over the long term. In the case of Newmont Goldcorp, we felt on a combined basis, we pro forma, we would have been close to 8 million ounces of production, but we could rationalize that operating portfolio more readily with a more expansive portfolio and achieve a sustainable production profile of 6 to 6.5 million ounces for 20 years. With what we already had in the pipeline, what we already had in production. I think similarly, if you looked at Barrick and Randgold on a combined basis, they were over 6 million ounces, but they decided that their equilibrium production rate would be somewhere between 5 to 5.5 million ounces, and they would be able to sustain that for 10 plus years. So it was getting to a sustainable production profile where you weren't constantly chasing your tail, trying to find another 7 or 8 million ounce deposit every year to sustain that production profile. There was enough in the combined portfolios to already do that without having to go and do any significant or large scale M&A going forward. And in doing that and achieving that scale and sustainable scale, we were able to realize a significant re-rate in the stock. When we sold Goldcorp into Newmont, we didn't take back cash, we took back paper. And so if you were a Goldcorp shareholder before the merger, you've effectively tripled your investment, both in terms of capital appreciation and dividends that have accrued to investors since the merger. If you're looking at the peak price that Newmont achieved earlier this year. So it was a significant win for Goldcorp shareholders, given the scale that we were able to achieve on a combined basis and the liquidity and re-rate that was inherent in that.
Okay, so as a CEO you were a CEO of a major and now you're involved with juniors. What were the priority differences between exploration activity of a senior versus exploration activity of a junior? Let's just draw the parallels with the differences between Goldcorp and you're now involved with Great Panther Mining. You're the chairman of that company. So in terms of greenfield exploration, how does Newmont do it? How does Goldcorp do it? How does Great Panther do it?
Well, look, I would say established producers are really not good at grassroots or greenfield exploration, and nor should they be, because when you're a greenfield explorer at a junior, for example, your mindset's different. You're more entrepreneurial. You're embracing risk. It's more almost like a merchant banking type of approach. You're not doing it expecting a rate of return, a defined rate of return. You're prospecting. You're following your nose, looking for the potential next big discovery. So inherently much riskier proposition. In fact, if you look at the value creation equation in the mining business, that's where you have the least success and the highest reward is at that very early stage. Whereas if you're running an operating company like Goldcorp, like Newmont, like Barrick, it's all about avoiding risk and mitigating risk, not embracing it. So generally the exploration tends to be more brownfield in nature, around existing deposits, leveraging your existing industrial complexes, extending mine life, looking for incremental expansions of your existing production profile. That's generally quite low risk. And even when you're doing something at the development stage within an established producer, again, that's all about mitigating risk. It's about getting to a sufficient engineering level so that you have a feasibility study that you can then approve and get funds approved from your board or from the market and a license to actually build it out. It's about achieving budget, hitting targeted rates of return. That is all about risk mitigation. It's a completely different mindset from what you see in the greenfields exploration stage of the mining business.
Sure. So when you were still CEO of Goldcorp, when you spoke to investors then, what did the shareholders want? What did they prefer in terms of expanding your portfolio? Did they see greenfield exploration or the acquisition of juniors as having a higher return of value? Which one had more higher net present value?
Yeah, look, they didn't want us doing early stage exploration. That's really not what they bought and currently do not buy operating companies for. What they buy them for is predictable earnings and dividends. They want them run like real businesses. And as a result, operating companies necessarily have to be about risk management, risk mitigation, and managing expectations. That's not the mindset within the junior game. The junior game is all about basically buying a lottery ticket. And if you buy my lottery ticket, you got the best chance of winning. And it is that kind of risk embracing mindset that is absent within operating companies, and necessarily so. I mean, with an operating company, it's about hitting quarterly consensus numbers. It's a grind. It requires a significant amount of discipline around operating processes and procedures. It's about hitting targets. It's not about looking and prospecting for new discoveries. If you have any success on the exploration side within producers, as I said, it's really about incremental exploration around existing operations and industrial complexes that you've already put significant capital into, and you just want to extend mine life and extend returns on those initial investments.
A fund manager I've spoken to a while ago, I've said that it should really be in the responsibility of junior miners and not seniors to do the exploration. Would you agree with that? And then the seniors should just be buying them out. That's what the seniors really should be focused on.
Precisely. I couldn't agree more with that. And in fact, we effectively outsourced our grassroots exploration when I was at Goldcorp. Even when I was at Agnico, I was the CFO there for 12 years. And Agnico, in the gold space, pioneered the practice of setting up an incubator fund to invest in gold juniors. We had a portfolio at Goldcorp, and for that matter, Agnico, back in the day, of 20 companies that we put small amounts of seed capital to work in. And we took a portfolio approach towards grassroots exploration. We outsourced it to the juniors. They're better at it. They better embrace the risk. And we acted more as portfolio managers rather than explorers. We didn't try to bet or put all of our eggs in one basket with one explorer. We tried to support the exploration community when they didn't have access to capital markets. And so Goldcorp was doing that at the bottom of the cycle. Agnico was doing that through the tops and bottoms of the cycle over many, many years. I was even doing it at Hudbay when I ran it on the base metal side. I invested in multiple juniors on the base metal side to allow them to do the grassroots exploration rather than try to build that infrastructure that you need to do that within your organization.
Okay, let's talk about royalty companies now. You are chairman and CEO of Gold Royalty Corp, which is currently a subsidiary of Gold Mining, but you're planning on taking it public. Walk us through the process here and the rationale.
Sure. So Gold Mining was founded over 10 years ago by Amir Adnani. Amir is the chairman of Gold Mining. And at the bottom of the cycle, he accumulated about 14 development stage assets. And he paid about $2.50 an ounce for 25 million ounces of 43-101 resource on those 14 development stage assets. At the peak of the cycle, when gold was over $1,900 10 years ago, those 14 public companies that he acquired that had those development stage assets collectively had a market cap of about $850 million. He paid about $83 million for those ounces at the bottom of the cycle. So he bought them for about 10 cents on the dollar. And admittedly, at $1,200 gold or $1,000 gold, these were sub-economic gold opportunities. But now approaching $2,000 an ounce, suddenly many of these development stage opportunities are quite attractive economically. Even at $1,500 gold, they generate attractive rates of return. So he's been inventorying these ounces, if you will, and now we're pivoting Gold Mining towards incubating. In other words, stage gating these projects, bringing them through feasibility studies, preliminary economic assessments, and whatnot, so that we can daylight value for the investors in gold mining. And part of that daylighting process was to actually write royalties on each of these 14 development stage assets of between 0.5% to 2% NSR, and put that into a separate vehicle that's 100% owned by Gold Mining, which I've now been brought in to chair and bring to market. I'll be IPOing it over the next few months. And that will provide an opportunity to daylight value for Gold Mining shareholders, but at the same time, provide us at Gold Royalty with a currency that we can use to transact with, to acquire other royalty opportunities and to diversify the portfolio beyond the mineral legacy that we've inherited from Gold Mining.
Are you thinking of cross-listing? A few miners I've spoken to this year have started listing on American exchanges.
Yeah, our focus is actually to look at a primary listing in New York on the NYSE American. So our focus actually is to carve out a niche there. There are very few royalty players that actually are primarily focused on the New York Stock Exchange. So our focus will be on a U.S. listing.
So David, you're involved with more junior projects now. If you were to build another Goldcorp from, let's say, something the size of Great Panther, what would you do differently? What would you do that was the same?
Well, look, I think there's an opportunity to buy operating assets right now through the combination of a number of smaller producers and creating scale more quickly. In my career, I've been involved in the construction over a dozen greenfield projects that are now and still are productive mines, both in the base and precious side. That's hard work. It's very capital intensive, inherently very, very risky. I think as an initial stage, we have to see some consolidation among these established producers, the smaller ones, to create scale more instantly. So the cost of capital for these companies comes down, so then they can refine the lost art of mine construction. As an industry, we have to start to put capital to work in development stage opportunities. But I think as an initial stage, we have to start to see the combination of some of these smaller producers to create the scale and create a lower cost environment to raise capital.
Okay, perfect. David, thank you so much for coming on the show today. It was a pleasure to speak with you.
Thank you for having me on.
I look forward to speaking with you again. And thank you for watching Kitco News. I'm David Lin. Stay tuned.